Hey everyone, welcome back to Corporate Decoder, the place where we decipher the secrets buried between the lines of corporate filings. This time we're diving deep into a report for the advisor's Inner Circle Fund III. And let me tell you, it's quite the financial roller coaster with some significant changes and performances to unpack. Before we jump into the nitty-gritty, if you love getting these straightforward breakdowns of financial documents, make sure you hit that subscribe button. And hey, we've also got a fantastic community on Discord where we discuss these filings in real time, so check out the link in the description below. Alright, so we're looking at a report from the advisor's Inner Circle Fund III, and it covers a period ending the 30th of September 2025. This filing essentially wraps up the annual shareholder reports for several funds managed under this umbrella, including the Radiant Quantamental China Equity ETF, the Radiant Quantamental Emerging Market X China Equity ETF, the Radiant Quantitative Developed Market Equity ETF, and the Radiant MDAM Japan Equity ETF. The big story here isn't just about how these funds performed, but also about some pretty substantial upcoming changes, and even a liquidation. Let's start with the Radiant Quantamental China Equity ETF. For the reporting year, it saw its net asset value, or NAV, increase by a solid 19.25%. Which is great news for investors as it outperformed its benchmark, the CSI 300 index, which gained 16.83%. The report mentions that this outperformance came from successful stock picking, particularly in information technology and communication services, sectors that saw significant rallies. However, they also note that being underweight in the information technology sector, despite its huge gains, was the biggest detractor from their performance over the year. This is a classic case of playing it safe hurting potential gains in a hot market. When we look at performance since its start in December 2020, things look a bit different. A hypothetical $10,000 investment initially grew, then took a pretty sharp dive by September 2022, recovering some ground, but still ending up at $8,245 by September 2025. That is a negative annualized return of 3.98% since inception. So while the last year was strong, the longer-term picture has been a bit of a struggle, trailing its benchmark, which ended up at $9,370 with a less negative annualized return of 1.36%. Looking at the fund's stats as of the end of September 2025, total net assets were about $21.7 million. They held 74 different investments, and the portfolio turnover rate was a staggering 249%. That really high turnover suggests a lot of buying and selling, which can rack up transaction costs and potentially generate more taxable events for shareholders, if this were in a taxable account. Sector. Wise Financials made up the largest portion at 23.6%, followed by Industrials at 13.0% and Information Technology at 14.0%. Interestingly, despite the IT sector rally, their underweight position there, as mentioned earlier, was a drag. Their top holding was Contemporary Amperex Technology, a battery company making up 7.3% of the portfolio, followed by Media Group, an appliance maker, at 3.4%. Now for the big news regarding this specific fund, on the 5th of December 2025, the fund will cease operations and be liquidated. This is a pretty significant event and usually signals that the fund is no longer meeting its objectives or isn't attracting enough assets to be viable. Shareholders will likely receive their NAV less any liquidation costs. Moving on to the Radiant Quantamental Emerging Market X China Equity ETF. This fund had a decent year with NAV increasing 10.26%, but it underperformed its benchmark, the MSCI Emerging Markets Ex-China Index, which gained 12.22%. The report attributes the underperformance to a low-risk exposure being a detractor, while high-quality growth stocks did well. Stock picking in India and materials was particularly weak, pulling down returns. Since its inception in December 2021, a $10,000 investment grew to $12,529 by September 2025, showing a positive annualized return of 6.12%. This is slightly behind its benchmark, which grew to $12,571 with a 6.22% annualized return. So, a mixed bag here, positive long term returns, but a slight underperformance compared to its index. As of the 30th of September 2025, this fund had significant net assets of about $78.6 million, holding 102 different investments. The portfolio turnover rate was a high 238%, again suggesting a lot of trading activity. Geographically, Taiwan dominated with 30.4% of investments, followed by India at 21.1% and South Korea at 18.2%. The top 10 holdings are heavily weighted towards Taiwan semiconductor manufacturing, which alone represents 17.5% of the portfolio. This concentration in a few countries and a single company is a notable risk factor for this fund. This fund is also undergoing some major changes. Effective the 19th of December 2025, it will be renamed the Radiant Wilshire NXT-Gen Emerging Markets Equity ETF, and its ticker will change to RENG. More importantly, its strategy will shift from actively managed to passively managed. This is a huge pivot and will likely involve changes to its investment objective, benchmarks, and fees. It signals a different approach to market tracking. Now, let's look at the Radiant Quantitative Developed Market Equity ETF. This one had a fantastic year, with its NAV climbing 23.18%, significantly outperforming its benchmark, the MSCI World Index, which gained 17.25%. The outperformance is credited to a focus on high quality growth stocks and those with strong investor sentiment. Since its inception in December 2021, a $10,000 investment has grown to an impressive $15,779 by September 2025, delivering an annualized return of 12.77%. This performance comfortably beats its benchmark, which grew to $14,379 for an annualized return of 10.04%. This fund seems to be a strong performer in the developed markets space. With total net assets of $104.2 million, this fund held 111 investments. Its portfolio turnover rate was a very high 318%, indicating aggressive trading strategies. Its sector weightings show a heavy concentration in information technology at 29.1%, followed by healthcare at 11.7% and financials at 8.3%. Geographically, the United States makes up a dominant 76.5% of the portfolio. Unsurprisingly, Nevada IDEA is its top holding at 6.3%, followed by Microsoft at 5.4%. This heavily tech-weighted and US-focused portfolio explains its strong recent performance, riding the wave of the AI boom. Similar to the Emerging Markets ETF, this fund is also changing. Effective the 19th of December 2025, it will be renamed the Radiant Wilshire NXT-Gen US Large Cap Equity ETF. With a new ticker RWLC, its strategy will also shift from actively managed to passively managed, marking a significant strategic overhaul. Lastly, we have the Radiant Semdam Japan Equity ETF. This fund also had a strong year, outperforming its benchmark, the Topix Index, with a NAV increase of 18.67% versus the index's 17.73% gain. The report attributes this to strong stock selection in industrials information technology and consumer discretionary sectors, and importantly, an underweight to the healthcare sector, which actually declined. This fund is much newer, having started in April 2024. A $10,000 investment grew to $13,390 by September 2025, showing a very strong annualized return of 21.60%, significantly outperforming its benchmark's 15.24% annualized return. Total net assets were $15.8 million with 32 holdings. The portfolio turnover rate was 41%, which is much lower than the other funds in this filing, suggesting a more buy and hold strategy. The sector breakdown shows a strong focus on consumer discretionary at 33.9%, and industrials at 23.8%. Its top holdings include Mitsubishi UFJ Financial Group at 6.3% and Fujikura at 6.1%. The strong performance and lower turnover here suggest a more focused and possibly more stable approach. Notably, this fund did not report any material changes during the reporting period itself, but we need to remember its sub-advisor changed in April, and the overall strategy shifts for the other funds might eventually impact this one too. Now, let's touch on the auditors and fees. PricewaterhouseCoopers LLP or PwC billed the trust over $228,000 for audit fees in 2025, a significant jump from around $808,000 in 2024 for services rendered to the trust and its affiliates, Ernst & Young LLP or EY. Also billed for audit fees around $144,000 in 2025 compared to about $138,000 in 2024. Cohen & Company Limited billed around $101,000 in 2025 for audit fees. The majority of these fees seem to be for standard audit work, with some tax fees noted for EI related to UK reporting status. The report emphasizes that the Audit Committee has a policy to pre-approve all non-audit services to ensure auditor independence. Diving into the actual investments, the schedule of investments for the Radiant Quantamental China Equity ETF shows a hefty allocation to financials at 23.6%, and the top holdings include companies like Contemporary Amperex Technology, a battery maker, and Media Group, an appliance manufacturer. For the Emerging Markets ex-China Fund, Taiwan semiconductor manufacturing alone is 17.5% of the portfolio. The Developed Markets Fund leans heavily into the US, with tech giants like Nvidia, Microsoft, and Apple making up a significant portion of its holdings. The Japan Fund, with its lower turnover, shows a concentration in consumer discretionary and industrials. Looking at the statements of assets and liabilities, the Developed Markets ETF boasts the highest net assets at over $104 million, while the China Equity ETF has the lowest at $21.7 million. The high portfolio turnover rates across most of these funds, especially the 318% for the Developed Markets ETF, really stand out. This implies a very active trading strategy, which can be costly and may not always lead to the best long-term results for investors due to transaction fees and potential tax implications. On the operations side, the net investment income for the Developed Markets ETF was about $603,000, while it was much higher for the Emerging Markets ETF at over $1.3 million. The realized and unrealized gains are substantial across the board, with the Developed Markets ETF showing over $15 million in net realized and unrealized gains. The statements of changes in net assets show significant activity. For example, the Developed Markets ETF saw a net increase in assets within its capital share transactions of over $23 million, indicating a lot of investor interest and capital inflow into that fund. The China Equity ETF, however, experienced a net decrease of nearly $20 million from capital share transactions, which aligns with its impending liquidation. The financial highlights are where we see some very interesting trends. For the Radiant Quantamental China Equity ETF, the total return for the year was 19.25%, but since inception, it is a negative 3.98% annualized. This shows a significant bounce back after a tough start. The Developed Markets ETF, on the other hand, continues its strong upward trend with a 23.18% return for the year and a very healthy 12.77% annualized return since inception. The Japan Equity ETF, being the newest, shows a 18.67% return for its first full year, which is quite impressive. The notes to the financial statements reveal critical information, like the upcoming liquidation of the Radiant Quantamental China Equity ETF around the 5th of December, 2025. This tells us that the fund hasn't met its performance goals or isn't attracting enough investor interest to keep going. Also, the upcoming strategic pivot for the emerging markets and developed markets ETFs from actively managed to passively managed is a huge shift. This usually means a change in investment philosophy, possibly aiming for lower costs and simpler replication of an index, rather than trying to beat the market. The ratio of expenses to average net assets is quite consistent across these funds, generally around 0.7% to 0.9%. This is a reasonable fee structure, but the high portfolio turnover rates can add hidden costs. For the China Fund, the expense ratio excluding waivers is 1.80%, which is on the higher side, especially considering its recent performance struggles before the rebound. The report from Ernst & Young LLP confirms that the financial statements present fairly, in all material respects, the financial position and results of operations for these funds. Their opinion is based on audits conducted according to PCAOB standards. They have also served the advisor's company since 2021, which is a good sign of a long-standing relationship. The notice to shareholders provides tax information. Notably, the Emerging Markets ex-China Fund has a significant foreign tax paid of over $456,000, indicating substantial international investments and likely higher income. They also mention passing through a foreign tax credit to shareholders, which is a common practice in international funds to mitigate double taxation, and can be a benefit for investors if they can utilize it. The renewal of the advisory contracts is a really important section. For the Developed Markets ETF and China Equity ETF, the trustees reviewed everything from the quality of services to investment performance and fees compared to peers. They found the advisory fees reasonable and performance satisfactory, leading to the renewal for the Japan Equity ETF. They also reviewed the sub-advisor's role and concluded the agreements were fair and reasonable. This whole process shows a rigorous oversight by the trustees, ensuring the fund managers are doing their job effectively and fairly. Overall analysis and opinion. So what do we make of all this data? The advisor's Inner Circle Fund III is clearly undergoing significant restructuring. The liquidation of the China Equity ETF, while disappointing for its recent performance, points to a necessary business decision to cut losses or to reallocate resources. The strategic shift of the emerging markets and developed markets ETFs to passive management signals a move towards cost efficiency and index tracking, possibly to remain competitive or to simplify operations. The strong performance of the developed markets ETF is a clear highlight, showcasing effective management in a favorable market. However, the very high portfolio turnover rates across most actively managed funds are a red flag. It can lead to higher costs and may indicate a less than optimal long-term strategy, potentially sacrificing buy and hold gains for short-term trades. The concentration risks in emerging markets, especially the heavy weighting in Taiwan semiconductor manufacturing for the Emerging Markets ex-China Fund, is a significant concern that investors need to be aware of. The future direction of these Rayliant ETFs is clearly moving towards simpler, more passive strategies, which may appeal to a different set of investors, but the active management of the Japan Fund still shows impressive results for now. It will be interesting to follow how these strategic shifts play out in the coming years. Alright, that is our breakdown of the Advisor's Inner Circle Fund, the third's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description. Thanks for watching, see you next time.